Hey everybody, David Tall here with Make Money University. And today's episode, we're going to talk about cash flow and how to calculate it. And I'm going to share a calculator that you guys can all use on your own to calculate any property's potential cash flow as you're looking on properties on Zillow, Redfin, and elsewhere to get a quick idea of what you can expect to make and what kind of return you can make. Now, last time we talked about how millionaires make money with real estate because nothing else beats making money with real estate, because you have cash flow, you have tax advantages and deductions, and then on top of that, you have the appreciation of the asset of the property. So that real estate gives you wealth in three different ways: tax savings, which is income, money saved is money made; cash flow, which is income literally every month; and appreciation of the property value. So today we're going to dissect cash flow, how to calculate it. And that way you guys can go off and either buy your first property or your fifth or your 10th or your 50th, but have a really strong fundamental understanding of how cash flow works, how to analyze deals, and how to start to build your portfolio or continue to build on your portfolio. So one of the most important things to keep in mind when buying property is that not every property is going to cash flow. Some properties may need some repairs, some upgrades, etc. For this example, we're going to keep it kind of simple, but I'm going to show you how you could just quickly add, other costs and expenses into the calculator and get an understanding. So that if you're buying a property that's 500K and you think it needs about 20,000 in, upgrades to get maximum rent, how to calculate that. And it's important because with cash flow, it's very easy to let it get away from you. And you're just trying to upgrade it and make the property perfect for yourself or for somebody else. But when you're buying for cash flow, think about it's an investment, and you're investing in basically a renter's ability to pay you every month. And so, yes, you want to make the property nice, but you don't need to put in all the highest end finishes on the planet that you would maybe put in for your personal primary residence. Obviously, depending on the market, if you're building a luxury rental somewhere, then maybe so. But for most people, they're buying properties that they're going to rent to, kind of median income earners, low to medium income earners. That's frankly where the best cash flow is. And you don't need to go to the most high-end finishes. It's about making something look beautiful, pretty, and giving someone a bit of a pride of rentership, so that they take care of the property and that you can get maximum rent. It shows really well in photos, etc. So I'm gonna dive in and show you guys a calculator that I created just for you guys. Let me share my screen 1 second here. And we are gonna move here to the cash flow calculator. All right, so we're on the cash flow calculator. I'm gonna include a link down below. Do me a favor and like and subscribe if you use the calculator. That will really help me out as I'm starting this channel and really trying to spread the education to more people around the country, because I believe that owning real estate and building financial freedom and equity is really a fundamental right. Everyone should have that kind of a life. I really enjoy my life. I really enjoy the financial freedom that I have, the ability to travel, the ability to do so many different things. And I really want to give back and help other people achieve those same dreams and goals, because it's you don't have to be a genius to do this. You have to take a little risk. You have to have a little patience, but fundamentally, fortune favors the bold and certainly favors the real estate owners. So let's dive in here to this cash flow calculator. What we have here are inputs. We have income and expenses, and then it'll spit out the results. The inputs, now everything here that's blue is what you can manipulate, okay? So the purchase price and how much down payment you're gonna put. Those are all things that you can manipulate. And it'll flow through the rest of the formulas down to the bottom so you can see what you end up with. For this example, I'm gonna say that we found a 3-bedroom, 2-bathroom, condo or small house somewhere, and it's about 500K, and you're going to put 20% down. Okay, you can put less, you can put more. You can mess with that on your own. That's the fun of it. It's really sort of a game of tweaking to figure out where the right opportunity is for you based on where you can start. And if you can only start with 5% down, fantastic. So I'm just going to put 20% for now, but you can manipulate it. Now rates today, so 500K, you put 20% down, that's 100,000. So your loan amount, it auto calculates it, is 400K. Your loan, which is what you're going to pay principal and interest on every month, is 400K. I'm putting here a 6% interest rate. Hopefully rates start to drop into the 5 soon, and it's going to make all these numbers even more exciting, which I want to talk to you guys about in just a minute as well, because buying properties today, and then if rates drop, property values go up because it's more affordable and more people can buy those properties. So then there's more demand, and then prices rise. So buying at a high interest rate, if the numbers pencil out, is not the worst idea, because as rates drop, and they ultimately will, values will spike. So it's one of the smartest ways to make money is in kind of rough markets. So this just breaks down your interest rate monthly from 6% to 0.5% a month. That's automatic. This is 30 years. It's a standard 30-year mortgage, so 360 payments. And it spits out your monthly payment. This is without taxes and insurance. This is just principal and interest, okay? So almost $2,400 a month on this property. Now, down here, we're going to put in the rent, what we think the property would rent for, okay? And you can check on different sites like Rentometer. You could check on Zillow, on Redfin, and others. They have rent estimates. And this is something that you can also check yourself. Like, go on Zillow and search for rentals of 3-bedroom, 2-bath homes in your market, or condos in that zip code, and see roughly what they're renting for. And you can get yourself a bit of an idea. And we'll go into some of that in another video about getting really precise with rental income. And it's a bit of an art more than a science. But there's some really easy tools out there that, any Zillow listing that you click on, it'll show you the estimated rents. And so I would take something in the middle of their range and just pump it in here. So I'm gonna pump in $4,500 a month in rent for this example. And this is based on a property that I recently saw. So from there, you have your gross monthly rent. You should always put in a vacancy, okay? Because the reality is that your property is not going to be rented 100% of the time. People will probably stay at least a couple of years, hopefully a lot longer, but it might take you 2 to 4 weeks to rent out in between. And so a safe kind of bet, rule of thumb, is to put a 5% vacancy rate. So that'll give you an effective monthly income of $4,275. Okay, taking the 5% off of the total rent. Okay, to be conservative, and it's good to be conservative and pad things with expenses so that there's more upside than downside to be had from any scenario. And I've been very good about being very conservative, and so at the end of the day, I tend to have more upside than downside on almost every deal. Now, property taxes here. I'm going to put at 1% because that's what they are roughly here in San Diego. In your market, there's markets where you have 0 property taxes, and there's markets where it's 2%. So you can play with this depending on the property tax rate. Ask ChatGPT or just Google, what is the tax rate in this market or this zip code or city, and pump it into the blue here, and it'll automatically calculate that payment as if it were paid monthly. Property taxes can be paid twice a year in most markets, sometimes once a year. But I recommend paying them monthly and building them into your mortgage payment. And that is a free option when you're getting a mortgage from any mortgage servicer or lender. It's called an impound account. And they take the annual property tax and they divide it into the 12 payments and include it in your monthly payment. That's the smartest way to do it, so you don't have big surprises throughout the year and it's being paid consistently. Insurance. For a smaller condo or smaller home, $50 a month will probably do it. You can go up to $100 a month if you want to be more conservative, but there's a lot of policies that you can get for about $600 a year that'll cover plenty. Utilities. Now, if you're renting this out, I would charge the utilities to the tenants. But I had this in here just in case it's a certain kind of a property where you're going to have to pay the utilities. But this is more rare. But it's here as an option, so you still use the calculator in the same way. If you have utilities, you need to cover. Repairs and maintenance. I always put a pad here because it's likely the fridge will break or the dishwasher or some small leak or something throughout the year. Once a year, maybe twice a year, there'll be some handyman you need to send out. So I think it's wise to put a small little buffer here. This is all monthly, by the way. So I'm putting here a pad of $75 a month that I can just count on being there. And when expenses come up and repairs, I'm not freaking out. And I kind of know I already padded for that. Property management. Now, if you only have a couple of properties, you're probably going to self-manage. I recommend that you do up until you have 10 or 15 properties. I think you should self-manage. It'll teach you a lot. And I did that up until I had 10 or 12 properties. I was self-managing them with my wife. When we got beyond that, it got a little out of hand. And that's when we got a property manager. So you could put in here, your property manager fee percentage, and it'll automatically calculate it, etc. So I'm going to keep it at 0 here because this is kind of for a basic example. You could put in HOA dues. Hopefully you're buying properties with little to no HOAs. I'm not a big fan of HOAs because they limit what you can do on the property, and HOAs never go down. They always go up. So your expenses will by nature just keep rising. Now they'll rise small amounts at a time, but it just sucks. And you'll remember properties that you bought 5-10 years ago where the HOA was $200 and now it's $400, and it just rubs you the wrong way. So if you can avoid properties with HOAs, or stick with properties with very low HOAs, but you can pump in an HOA number in here. And other expenses, if there's just other things you want to pad, just be conservative about. I added this row here just so that you have it. And now that calculates your total monthly expenses at $1,280 in this example, okay? Now, what that does is it leaves you with your net operating income, okay? Net operating income is what it sounds like, the net income after all operations, basically after expenses. So what this is doing is it's taking the total rent, including the vacancy, it's subtracting your monthly payments to mortgage and your expenses, and it leaves you with about $600 a month cash flow, right? Net income. Annualized, that's about $7,000. Now, in this example, you only put $100,000 down. You put 20% down on a $500,000 property, okay? So the annual return on investment, or your ROI, your cash flow return, is just over 7%, which, by the way, is phenomenal because this is just cash flow, right? So you're making 7% on cash flow. Then you're making a lot of you're getting a lot of tax savings from depreciation, cost segregation, writing off property taxes, you can write off all the interest payments, all of that stuff you can write off. So it reduces your property taxes. And then you have appreciation. Over time, inevitably, this property will go from $500,000 to $600,000, $700,000, $800,000 and more, frankly, right? I mean, look, 20 years ago, everything's more than doubled. Look, 30 years ago, things have more than tripled. It is just the nature of it. So this property will one day be worth, call it $700,000, probably in 5-10 years, right? And so if it goes to 700, your return is not just the 6% or 7% you made per year, but it is now also an extra 200,000 on the 100,000 you put in. So you're turning 100,000 into 300,000. You're tripling your money, and on top of that, making 7% on your money, and on top of that, saving taxes. And so this is how the rich get really rich. It's a long-term play. Now, my philosophy is always about cash flow and financial freedom. So I don't like to buy properties that are not cash flowing at least 5%, 6%, something in that range, because I want to make that as a steady state income stream that I keep getting. But I also want to keep my eye on the long-term view that, hey, over time, I'm building a lot of more equity in this property. It's going up a lot in value, and I'm also paying off the property each month. So that's another thing we didn't count in here. Principal and interest. The principal is actually your money that you are paying back. So whenever you sell it, it's the loan that you're paying back, and it's now your equity. So if you pay $10,000 a year towards the principal outside of the interest, that's another $10K that's counted here as your expenses, but it's actually kind of a forced savings account because you get that back when you sell the property. Because when you sell the property in 10 years, you're not going to owe $400K. You might owe $350 or whatever the number ends up being because you've been making payments, paying it down, right? So there's just so many different angles. Even as I talk about it, I keep thinking of other angles of how real estate makes you money through a web of different, streams and avenues. But I want to tell you one last thing that I think is really, really key, which is that this is not going to stay like this. We talked about, the property going up to 700K or 800K. But the rent is not going to stay 4,500 when that happens. The rent goes up almost every single year. In some markets, it goes up 5 to 10% per year. On average, it goes up 3 to 5% per market per year. Okay, 3 to 5%. So here, let's just calculate what 4% is. Okay, something in the middle. So I'm going to do this times 4%. I get 180 bucks a month. So in a year, you're going to make $180 more per month. Okay. Now in this example, you're making $596 year one. Now year two, let's add 180. Now you're adding 180. Now guess what? Your expenses stay the same, but your income goes up. So the return just went from 7% to 9% 1 year later. You're talking serious returns here. Now year two, it goes up another 180. Your return is now 11%. Do you see how this is just in 2 years. Let's call it in 10 years. In 10 years, you're going to increase it by $1,800 a month. Okay. So in 10 years, your $4,500 property will rent for $6,300 a month. Okay. And now your return is 27% a year on that same money. This is how the rich get rich and richer. It's patience. It's having a good return day one, 5-6%, but not being so stubborn about it, because you're got to keep a long-term view. You're making money with appreciation. You're making money with tax savings. Okay. You're making money because you're paying back the loan every month as well. You're making money because rents go up every year. Okay. And so this is what gets so exciting about it. And before you know it, 10 years is going to fly by. And if you have a handful of properties that are each making you 27% and they've each gone up 200-300K, you've made millions of dollars. And that is how the rich get rich. This is what I have done. And I've done this. My first property that I ever bought was $75,000. And it went up to 300K. My second property I bought it around the same time for 100K, and it went up to about 350K. The money I'm making off the rents is significant. It's 40-50% return now on the money I put in, but a small amount of money I put in. But I've made hundreds of thousands on each of those properties in equity. And I've been able to do that dozens of times. And now I'm selling some of those properties, taking the money and doing it again with bigger projects, bigger properties, fourplexes, duplexes, starting to build ADUs on those properties. I'm going to go into that in some other videos as well. But for this video, I just wanted to give you guys this really important cash flow calculator. I hope you guys use it. Let me know what you guys think. And if there's something here that's missing that you want me to add to the calculator, happy to do so. Happy to look at different projects that you may be considering. Drop them in, and the community can comment as well. I'm going to reset this back, and I'm going to share this as a view only, so you can take it and make a copy of it, download it, and use it on your own, however you'd like. So start building some wealth, start building some cash flow, and I'll see you on the next video where we'll talk about some more ways to make money with real estate. Cheers, everybody.